In this module, we'll be doing once again some practice to learn double entry bookkeeping. Very important, please be attentive, and you see, by doing this practice, you will be perfect in learning debit and credit. Okay, let's move forward. So in this practice question, once again, we are revising the same concept in which we will be identifying debit and credit effects. So transaction number 1 is owner is starting business with 10,000 in bank. Okay, what we see in its answer that there is a bank as one accounting head and the second accounting head is capital. So bank is an asset and owner's equity is the main head for capital. Bank, which is asset, has debit group and owner's equity is credit group. We are having increase in both. So whenever there is increase in debit group, analyze it as debit, and whenever there is increase in credit group, analyze it as credit. The next transaction is paid insurance by check. Remember one thing, that here we are making payment of insurance by check. Whenever there is payment by check, the accounting head would be bank. Let's see. Bank is one accounting head and insurance is the second accounting head. Bank is asset, debit group. There is decrease in the bank balance because we are making payment for insurance out of the bank. So the bank balance will decrease, means asset will decrease, credit effect, and insurance expense is increasing. So debit group is increasing, debit effect. Well, next comes owner withdrew goods for personal use 2,000. Okay, so drawings is one accounting head, owner's equity, and because of drawings, there is decrease in owner's equity. Owner's equity is a member of credit group, and whenever there is decrease, it would be debited. And the second effect goes to purchases because owner is withdrawing goods. So whenever owner is withdrawing goods, the purchases, which are the expenses, member of debit group, would be decreases, and whenever there is decrease in debit group, and should be analyzed as credit. Next comes machinery purchased from Maria and Company on credit. So we are buying machinery on credit. Okay, well, so buying machinery on credit, there are two accounting heads, machinery and creditor. Machinery is asset, creditors are liabilities. Asset belongs to debit group and liabilities belong to credit group. Both are increasing. So debit increase debit and credit increase credit. Okay, simple is this. Next comes loan taken from friend, rupees 200 in cash. So loan taken from friend, 200 in cash. Cash is an asset, belongs to debit group, increasing since we are receiving loan. So loan is being received in cash. Cash asset will increase, and loan from friend becomes our obligation, liability. Liabilities belong to credit group, and increase in liability is credit. Okay. Next comes machinery returned to Maria and Company. The machine that we purchased in this transaction number 4, we are returning it to Maria and Company now. So what will happen? Let's see. Again, the accounting heads are same. You see, machinery and creditors. Their main heads would also be the same. Group is also the same. But now, since we are returning machine asset is decreasing, and we are also reducing our liability because we don't need to make payment to Maria and Company in future now. Understood? Here both were increasing. When we purchased machinery, it was increased, and liability was also increased. But now we are returning machine and liability. Both are decreasing. So whenever there is decrease in debit group, we have to credit. Whenever there is decrease in credit group, we have to debit. That's great. Good learning. Well, so next is goods returned to Kashmiri rupees 100. Transaction number 7. Goods returned to Kashmiri rupees 100. Well, here we are returning goods. When we are returning goods, means these are purchases returned. So it is, since purchases were expenses belonging to debit group, when we are returning goods, it will be decreasing our expenses, so would be credited. And obviously it will reduce our liability. When credit member is reduced, it would be debited. Okay, and here we go for goods returned by Haris. Now Haris is returning goods to us. Okay, so when Haris is returning goods to us, what does it mean? It means that these are sales return. Since these are sales return, being returned from Haris, Haris was our debtor. So this debtor belonging to debit group is decreasing, therefore should be credited. And sales return are, in fact, were sales income before. Now that sales income has been reduced because of this return. So sales income was belonging to income group. So the group would remain same. And income is credit group. Should be debited now because it is decreasing. And next comes transaction number 9. Free sampling of goods for rupees 50. Free sampling, we are giving goods as free sample. So means purchases which are expenses would be decreased, and debit group was for these expenses. When we are decreasing, it would be credited. Okay, obviously goods purchased were debited to purchases account, and now those goods are being given as free sample. So those purchases which are in fact the expense would be decreased, and free sample will become our expense now because we will be taking economic benefit in future because of this free sampling. Okay, so this will be our expense and should be debited. Very well. Next comes transaction number 10. Friend's loan. Friend's loan was repaid. So we are repaying friend's loan. What is happening? In fact, we are making payment of cash while repaying this loan. This cash, being asset, being member of debit group, is decreasing and will be credited. And loan, in fact, it was our liability, being member of credit group. Liability has been reduced, should be debited now. Okay, so this was a very good practice. Let's do one more practice, which is very simple, that we have to choose correct answer from these options given under each transaction. So goods purchased from John Smith, it's a credit transaction and increasing our creditors and stock. Then commission paid to agent Jordan, it is a cash transaction. We are making payment in cash for commission. Cash is decreasing and commission as an expense is increasing. Remember, it's an expense. We are making payment of commission. Then goods sold for rupees 5,000, that cost 4,500. So it's selling goods for cash means we are receiving cash. So cash is increasing with 5,000 and sales are also increasing with 5,000. We are concentrating on sales part only. Then comes goods returned from debtors. So when we are receiving goods as returned from debtors, debtors balance will decrease and sales return will increase, which will ultimately reduce the sales income amount. Then cash received from debtors on account. Okay, So we are receiving cash means cash increase, and debtors balance will be reduced because we had to receive cash from debtors. They have paid us. Now those debtors balance is no more a receivable. So minus debtors. Loan repaid to Hassan. So Hassan was our liability. We have made payment to loan, payment of that liability to Hassan. So that liability is minus, and cash is also minus, being cash is an asset and we are making payment of our obligation in cash. Then cash withdrawn by owner. So whenever there is drawing, the cash is reduced, cash minus, and the drawing also reduces owner's equity. Machinery purchased from Caterpillar on credit. Well, we have purchased machinery, machine is increasing, and at the same time, since it is a purchase on credit, so liability is also increasing. It is becoming our obligation to pay in future. So these are the answers to it that we have practiced, and very important to learn their tips. The important tips to remember that for payment through check, use bank as credit accounting head, and for decrease in purchased goods or stocks other than because of sales and purchase return transactions, use purchases as credit. Very important tip to learn. And for goods returned to supplier, use purchases return as credit accounting head. And for goods returned by customers, use sales return as debit accounting head. Thank you.